Hello, I'm Daniel Gross. I'm the columnist at Newsweek and a columnist at Slate, and my work also appears on The Big Money, which is the new financial news site started by Slate just within the last few weeks.
And I'm Yves Smith of the blog Naked Capitalism. In my real life, I'm a management consultant.
We're here. This is Wednesday morning, the 8th, probably, day 97 of financial crisis 2008?
Gee, I hadn't put a day on it. I always think of it as having started in August of last year, but in terms of the acute phase, you're probably
so
right.
So we're probably maybe day 456. One of the great things about cable news is that they always very quickly brand disasters. They have like a little moniker, fire in wherever. I was wondering with the, Wall Street meltdown. I haven't seen any really good one, although I'm sure CNBC is working on some of them.
Well, I think it's that people are trying to avoid words like depression,
yes,
even though you're now seeing that in the press on a daily basis.
Well, maybe that's a good place to start. I find, the trope that is used, both in business world and also, especially in politics, we hear, at the debates, this is the worst financial crisis since the Depression. And on the one hand, technically speaking, that's true. Perhaps we haven't had something so severe, since 2930. On the other hand, it's sort of meaningless. It's like saying, you had a boat accident where 50 people died and said, oh, that's the worst since the Titanic. The orders of magnitude strike me as, as much as we're worried about them and impacted by them, especially here in New York, nothing close to what happened during the Great Depression. The GDP fell by 25% over the course of 4 years. We didn't have deposit insurance. The number of bank failures was in the thousands. And I'm finding that, as someone who dabbles in history, I think it's great that they're talking about it, but I find that to be a less than useful comparison. What do you think?
Well, yes and no. The theory is that because we have better mechanisms now, because the regulators understand better, that we can avert that kind of crisis. But the fact is that that it was actually a rolling crisis in the Depression. The crash was the first event. The ratchet downs took place in 30-31, and the real sort of the combo plate coup de grace was the British decision to go off the gold standard when none of the other countries initially did. We didn't go off until 1934, and the second was a German financial crisis of 1931. So there were successes. It wasn't a one-time event. It was a rolling crisis. And the issue with our current crisis is that candor, two things have happened. One is the offset. The other is what has the potential for this to get a good bit worse. The reason things haven't been bad so far is that the initial phase of the crisis really has been concentrated in U.S. institutions, even though there obviously have been overseas exposures. Mm-hmm. And we've gone through all of these, liquidity measures that the Fed has implemented, which have kept the damage from rolling through to the real economy. The sort of shocking thing is, despite the appearance of a credit crisis, there has been, until very recently, actually no aggregate credit contraction. If you look at the Fed flow of funds data, through end of March 2008, the credit growth in the economy as a whole was still on a hyperbolic. I kid you not.
The amount of debt on credit cards, home loans, car loans, totaled up was still rising.
And even as of the end of the next quarter data, it was still increasing, although the amplitude of increase had really tailed off. And the reason that we haven't seen the hard impact is that frankly, with all these liquidity measures, our friendly foreign funding sources have been very accommodative.
And by that you mean the
China, the Gulf states, they still continue to buy our paper.
Okay.
And the paper has not gone up, and now we have this rush to treasuries, which is a different phenomenon, but I'm speaking of the, before this last, before this intense phase that we're in now. In fact, one economist, Brad Setzer, has placed it at the total size of the, as he calls it, quiet bailout, as about $1,000 per person. Now, to put that in perspective, the size of this so-called bailout plan, the Paulson plan that has just been passed, is about $2,000 per person. So we're massively leaning on our creditors more because there's no way we're going to put in through tax increases that are going to pay for
the next time you go, one goes shopping at Saks and buys a $500 sweater on a credit card, you should be thanking sheikhs in Abu Dhabi for extending you that credit.
Exactly. Well, and that's the other part is now the credit lines are starting to be cut more aggressively. For example, American Express has announced, and they have a much higher on average credit score client than the other credit card issuers. They've said that they've made it very clear that they're taking a much tougher line on credit line reductions,
right.
And we've seen a little bit of that with some of the banks, that they started cutting their home equity lines of credit. But we're going to see more of that sort of thing.
Now, I want to go back to the Depression comparison briefly, because I think I've been generally rather pessimistic about the U.S. economy and our ability to weather this all. But looking back, as you say, it was this rolling crisis that happened, and it did go global. But we had, I'd say, a combination of both spectacularly bad policy in terms of, Treasury Secretary who just basically wanted to liquidate everything. There was no real effort, no great effort at stimulus, I should say, and the sort of macro policies were all in the wrong direction. And at the same time, the Federal Reserve was a pretty immature, weak institution, and we lacked, deposit insurance, which has helped stop, I think, a lot of the runs on the bank. I do take comfort. Obviously, a lot of these New Deal era mechanisms are now 75 years old, some of them creaky, showing their age, some of them in danger of collapse. But I do take some comfort in knowing that these institutions that have been around, I think, provide some sort of shock absorbers that did not exist the last time around. Back in the 30s, they could be overwhelmed, but at least they're there.
Yeah, no, we have social safety nets and we have certain backstops, agreed completely. The concern I have is back to what you were saying about policy errors. We are making policy errors now. That's the scary bit. And again, I hate to harp on the Paulson plan, but it would be hard, well, I shouldn't say hard to design. You can always come up with worse, but it is badly misguided.
By the Paulson plan, you mean the big bailout?
The big out of $700 billion that was just hustled through Congress.
And for you, that's number one bad policy of 2008?
Yeah, the top. In fact, what's shocking is this so contravenes. Suddenly now that we're having a financial crisis, there's been a tremendous amount more work done on past financial crises by economists, and it's very clear. I mean, the evidence is unambiguous that the most successful prescription is to let the asset prices fall so you can find out how badly the banking system is undercapitalized and recapitalize the banks. And in a very severe banking crisis, you have to do triage on the banks. Which banks are winners, which banks have to go, and even among the ones who go, which get merged into the winner banks.
And by banks,
which ones get liquidated?
And by banks, do you mean commercial banks, or do you also mean sort of shadow banks, investment banks?
Well, that's the whole problem with this. Is that's the other critical point. Is that even though we've got the backstops on the formal banking system, we've now had a growth on this shadow banking system, and all the Fed's remedies have been direct, and partly because that's where the Fed's got the tools, but this winds up looking like the drunk looking under the light for his keys, because that's where the keys were lost. There's not been a lot of thought given to how do we and to what degree and how do we backstop the shadow banking system, because that's where a lot of the run is occurring. I mean, for example, the next, Nouriel Roubini, who's been the most accurate in calling this credit crunch, has said there's going to be a run on hedge funds. That's the next phase.
We should probably explain what we mean by shadow banking system, and I think this is going to be sort of the next big thing that mainstream business media starts to pick up on, or we will start to see kind of big takeouts and big pieces on this. To me, it means this whole kind of complex of financial companies that have arisen outside the commercial regulated banking system that get their funds from the capital markets, i.e. from Wall Street, from each other, from wherever. So these are the investment banks, the hedge funds, It could be insurance companies like
Well,
AIG.
exactly.
It could be five guys sitting in a room somewhere who just lined up some big lines of credit and decided to start writing insurance policies on other people's debt. These are the credit default swaps. I guess by definition, and we call it the shadow banking system because it's not regulated. It's tough to get a handle on the size, and the disclosure levels are nothing like we have for commercial banks. And I think that's, we saw with AIG going down, the need to save that for the sake of this other large system. You talked before about the sort of policy errors. I think, the conventional wisdom when Lehman Brothers, when Henry Paulson let Lehman Brothers fail, was kind of good for him. They deserved it. This sends a message about moral hazard. We can't just save everybody. These guys screwed up. This will send a message and kind of get religion into people to start deleveraging. But I think maybe the emerging next piece of conventional wisdom is that might have been a mistake letting them go like that, because they had so much debt out there. It was something like $550 billion in debt they had issued, and the seizing up, it triggered a chain reaction that helped perhaps lead to a run on money market funds, which in turn led for a need for another sort of federal bailout / backstop. At the time, I recall thinking and probably writing somewhere that, yes, it served Lehman right. They ran at these atrocious levels of leverage. Here was Paulson drawing a line and kind of sticking it to some of his former rivals. Now I don't know. I'm sort of less convinced that was the best policy course at that time.
Well, no, and in fact, you're absolutely correct in terms of both the original consensus view and the current consensus. And I would add to that saying that what shocked me about Lehman in retrospect, hindsight's always 20/20, but that what happened, part of why that bankruptcy wound up being so devastating was that initially people looking at it assumed that, and I would imagine this is the assumption that Paulson and Co. went on, was that it'll take $10 billion to plug the hole in the balance sheet. The belief was that if they were looking at the time to raise money,
right?
And I think they were. The Korean Development Bank was a possible source, and they were also looking at selling one of their sort of crown jewel businesses. But the thought was, gee, if they raised $6 to $10 billion, they'd be viable. Now they wouldn't be viable forever, but they could kick the can down the road for at least a couple of quarters, and who knows what the world would look like then. So the thought was that the number was maybe the short if they were insolvent, we were talking maybe $10 billion in losses. Well, when they went under, it turns out now they're looking at the prices are looking for the settlement on their credit default swaps. Remember, when you write this credit default swap insurance, if you wrote the insurance, you have to pay the difference between 100 cents on the dollar and whatever it settles for in bankruptcy. They're looking at apparently 80 to 85 cent payouts. They're looking at basically what was $100 billion, not a $10 billion hole, but $100 billion hole in Lehman's balance sheet. And why didn't Paulson and crew know how bad this was? Lehman was on the ropes for months. This wasn't like Bear, where it fell over in 10 days. I mean, to me, the failure to assess the situation properly is breathtaking.
And what you're saying is, in practicality, Lehman files for bankruptcy, and then it starts a process of trying to pay off the debt that it's owed.
Right.
And that the creditors are basically, with Lehman, by selling its assets or rounding up whatever cash it had and unwinding positions, is basically only paying 20 cents on the dollar, or able from its own resources to pay 20 to 25 cents on the dollar of its debt, and that so the people who insure the debt are having to come up with the rest? That's
correct. Well, there's a hierarchy, because some of the debt was secured by specific assets. So there's a big chunk you have to pull off that because it was leveraged, just the same way you borrow against your house. Your house is a security. If you go under, the bank grabs your house.
Right.
Lehman had specific assets that were pledged. So a big chunk of that $550 billion you mentioned, that's going to be handled by specific assets. Right. But then there's a big pool left that is what they call general credit, where it was secured, where it was, so again, if we're talking about an analogy to the person, you've got, your car loan is secured by your car, your house is secured, your mortgage is secured by your house, but if you're talking about your credit card, that's general credit.
Right.
Or, if you have an account with your grocery store.
It's equivalent
or
to
cleaner.
the bank seizes your house for non-payment of mortgage. The mortgage is $100,000, and they mark down the price to get rid of it and try to recover some of their debt. But they basically have to mark it down from 100 to 20 or 25,000 instead of maybe 70 or 80, which is typical.
That isn't most of that kind of debt, that secured debt for a securities firm. They watch that collateral pretty closely. So those secured, again, I haven't heard that any of those people took big losses, but that's something they actually mark on a daily basis and make they make people settle up. So that they probably, I would be surprised if you saw any losses on that chunk. But the chunk that was left, once you take those pledged assets out, that was where you had those huge losses, where everybody thought, everybody, again, as I'm saying, going in, and I don't know what the exact numbers were, but let's say Lehman had, I don't know, 100 billion, 200 billion, some number like that, that was general credit. That's the part where they're having these huge losses, and nobody thought Lehman was in that bad shape. And that's what's caused and I think that's caused a second level of panic, because here we thought we understood, here's somebody on the ropes we've been watching. We knew this was going to become a cropper, but here it was so much worse than what people thought that I think that's also caused a second knock-on level of panic.
To change the subject slightly, as a journalist, I traffic in anecdotes. For me, once is a phenomenon, twice is a coincidence, 3 times is a trend story. So I'm always on the lookout for things. And one of the things I look out for is sort of signs of distress, because we live in this area that is and work in this area that is so dominated by financial services. I live out in the Connecticut suburbs, and so I have my own indicators that I look at. Mostly, the one I've been looking at is kind of the parking lots at the train stations and the crowds on the trains. Are they thinner? Is it easier to get a parking spot because fewer people are going in to work? I know you live on, I guess, the Upper East Side. Are you noticing sort of signs of distress among, the people, most of our neighbors and colleagues who make a living in one way or another in this, economic ecosystem? What would you look for sort of in your own neighborhood and as you go about your day?
Well, it's funny. I'm not seeing the kind of obvious signs that I would have expected. I mean, just, sort of walking on the street. I remember in the '87 crash, I happened to be able to walk just where my apartment was located and where my gym was located. I would walk down a long stretch of Madison Avenue to get to my gym. In the '87 crash, the quarter afterwards, and this is a quarter running up to Christmas, the stores were empty. The stores were empty. No one was in them. It was like you turned off a light. I walk around and the restaurants still look busy. So people don't seem to, on the one hand, at least superficially, people don't seem to have clamped down on their day-to-day spending. Now, I can't really assess their big-ticket items. The word is that people have really, big-ticket discretionary items, that people have cut back on that, but that's not something I can readily track. The flip side is I see signs that kind of go against that. I'm seeing a lot more little store closings.
Okay.
But not all of that was necessarily contraction related, because some of this was
Right.
Sometimes it was landlords not realizing the state of the economy. You can see ones where it's several in a row, so clearly the landlord raised rents and people weren't going along. But so that on the big avenues, like on 3rd Avenue, 2nd Avenue, I'm seeing signs that more stores are tipping over.
And what would be a sign for you of severe distress? For me, it would be if I went to Saks to get a new pair of shoes and someone was actually nice to me and paid attention to me, then I'd know that there was really widespread distress and perhaps, in fact, even a bottom. Is there something you would look for?
For me, it would be more anecdotal. I mean, again, the last cycle, and this cycle is going to be worse, but the thing that I was hearing was, and I'm sure we're going to hear this real soon, is parents having trouble paying for their kids' private school bills. Okay. That was a biggie in the 2000, in the dot bomb era. So that that would be. And I did see an indicator earlier, but that was more gas driven. The people were definitely not did not go away either Memorial Day weekend or Labor Day weekend the way they normally do. There were a lot more people in town.
So if we start seeing town cars idling outside PS6, so they're driving their kids to the public school instead of to the private school, that would be a sign for you that things are really bad?
Yes.
Well, there are many indignities in life.
Yes.
What do you think about? I guess we have to end relatively soon, but to me, one of the big things about this week, and that I'm going to have to be writing about, is the way that this kind of sudden shift where this seemed to be a U.S. concentrated phenomenon. These bank failures, credit meltdowns, bailouts. The Europeans were looking at us saying, there was this cover story in Der Spiegel saying, look at what you've done to yourselves. This is characteristic of how you roll. It's that cowboy capitalism, short-term thinking, market fundamentalism. Look where it got you. And, we've been feeling sorry for ourselves because our currency has been weak. We see the Russians buying up everything in sight. And then suddenly this week, it's like the shoe is on the other foot, or they've joined us in the sick bay. We have all these European bank bailouts. We see Russian oligarchs getting margin calls. The dollar is resurgent. Is it a question of, now the world thinks that they're in trouble and they could be worse than us? Or is it more a question of, we've been in quarantine and we're just happy to see sort of someone else who has caught the same illness as us?
Well, in terms of the situation in Europe, it would be premature to say that who's going to wind up worse out of this situation. In theory, I mentioned the policy mistakes we seem to be making here. In Europe, the issues are somewhat different, although they wind you up in a lot of the same place. The banks there are much more leveraged than in the U.S., meaning that they carry a smaller percentage of equity relative to their total assets.
So the Europeans were more cavalier in loading up on, the European financial institutions were more cavalier on loading up?
Well, they were permitted. I mean, that's a curious thing, is that in some respects their regulations are tougher than ours, but they permit a higher level of leverage.
Okay.
So they had much less room to make errors than we did. And then, some of it was that there were some institutions, there were a couple of German banks that got in trouble fairly early on, although initially that just seemed like an isolated case. They had bought U.S. subprime securities, so that was the cause of their demise. Okay. This latest series of episodes appears to be more related to the fact that there were different EU housing markets that were also very badly overheated. The British market was... Yeah, the UK, Ireland, Spain, and the Baltics, all crazy. And also in Ireland, I think it's true I don't know about Spain. I think Spain, it may have just been housing, not consumer credit. But certainly England, Ireland, and the Baltics have also had big-time growth in consumer credit. So they've got, they're not systemically, you could say, systemically, they didn't load up they didn't indulge consumers in the EU in aggregate the way that we did. But the problem is you've got contained markets where it happened. And for example, one of the players that fell over last week, the Hypo Bank, Hypo had an Irish acquisition.
Right. Hypo is a German. It's a German bank.
It was a German bank, but it did an acquisition in Ireland, so that was how it got exposed. But in any event, the policy error that is not the policy error, but if they don't resolve this, it's got the potential to be a major policy error, is that the Europeans got together over the weekend, and some things they harmonized. They said we're going to have a consistent policy on deposit insurance, so we don't have beggar thy neighbor. One country has better deposit insurance, and all the deposits run to the country that's got better deposit insurance. Right. So they're attempting to coordinate, but the issue is that the Germans, back to their classic, Bundesbank mentality. They feel they've been the most conservative about managing things. The Germans have taken a very hard stance on every country's responsible for its own banks. Well, now, in cases where...
just as long as they don't start annexing the Czech banks, then we could have trouble.
Right. But in any event, the issue is that, we've had banks go, for example, Fortis Bank went under, and that actually took three-country coordination, and they were able to pull that off. And the Germans are of the view that, gee, we can do this again. Well, so far the banks that have failed, that have required coordination, were ones that weren't too enormous. I mean, they were big, but they weren't the mega players
right.
like, say, Deutsche Bank or UBS, which are huge institutions. And the countries that were involved in the bailout, frankly, are kind of rational. They didn't have a lot of ego about negotiating. They didn't let the politics of the problem get in the way. You could very easily have a bank go under where you don't have such a let's get it done attitude among the countries that are negotiating. And if you have a failed negotiation on the rescue, and you've got a Lehman. I mean, HEPO was almost a Lehman scale institution, for example. These have the potential to create the same kind of damage.
What I find interesting is that just as our sort of debacles and meltdowns have exposed either, we want to call them flaws in our character or kind of wrinkles in our financial system, what we've seen in Europe and the reaction to it and the way it's developed, I think, says something about perhaps flaws in the setup of the European project. They have a single central bank, which is the entity that's supposed to kind of help in these issues, or that's leading the charge here, but it controls monetary policy. It doesn't control banking regulation. So you have one central bank, but you have the Germans making regulations for German banks, France, and so forth. You have different deposit insurance regimes. So you have a common market, the Eurozone, maybe the size of the U.S., with one central bank, but 50, however many prime ministers, however many different regulatory schemes, and so the idea of sort of a swift action over a weekend, like we had repeatedly in the U.S. as efforts to forestall crises, that really can't happen there because there's no one who has the authority and the tools and the firepower to do something like that. And that could be, on the one hand, that could be a plus because it lets markets sort things out ahead of bailouts maybe, but on the other hand, it could be a negative when you're dealing with issues of debt and leverage at this level where, pretty much anybody is vulnerable.
That's right. I mean, exactly right. I mean, so far their kind of ad hoc approach has been successful, but it places them at great risk.
All right, and with that, I've got to go check to make sure no financial institutions failed while we spoke.
Okay.
And, given that it's been a half hour, I think that the likelihood is actually rather high that there's been one.
It's actually kind of high. Okay, well, I enjoyed speaking with you. Thanks so much.
With you. We'll do this again soon.
Great. Take care then.
Bye.
Bye-bye.